Welcome to the session here. Since the 2D book, the foreigners will not understand, did not explode, you will have the fireworks and the tsunami all in one today. You can take pictures, but I can already tell you that my session will be on video. It's very rich in content. It's going to be pretty fast as a tsunami goes forward. And you can review it multiple times afterwards. You will get the link from the organizer. So all that said, I'm focusing on global venture capital, corporate venture capital, and then zoom in on Europe. And everything related to Switzerland will be a session with Thomas Haemmig on Swiss venture capital, and he will provide the data on Switzerland. So drivers for innovation and venture capital, venture creation, VC investment trends and exits, fundraising environment, corporate venturing, going global by any dimension, and then valuation and performance. And I think the last part will be the biggest surprise for any of you guys. So talking very quick on innovation, most people think on technology innovation, on product innovation. But the reality is, if you can combine it with a process innovation or business model innovation, this is where you get the big home runs in most of the cases. This, a quick one to show, is large corporates that have an international, that do a lot of R&D and have more than 60% of their R&D activities outside the home country, beat their counterparts who focus on domestic innovation only on all four major financial metrics: stakeholder returns, operating margin, market cap, returns on asset by about 40%. And they're tapping more and more and more, and I'll show you later, into startups that are also international, or combine their international R&D centers with, in their new locations, with domestic startups in those regions. So when it comes to venture creation, I have no time to go into the details. It's more complex than you think. It's not just the idea, oh, we are going to set up now a startup, cool idea. I have no time to go into any of those, but I put this together several years ago to explain on each of the 5 key elements what's behind the scene afterwards. So let's look at the global versus European stage and some other geographies. I threw in just 3-4 slides on Q1 because, as you will see through the data, venture is very cyclical. I'm coming back to this. And there was a recent downturn after the super hype in 2001 plus 2002. And now the question is, are we coming back? And what does it mean? And it looks like Q1 looks like a first sign of coming back. And funding was at almost $60 billion with 6,000 plus deals around the world. And you look at the US typically takes up a bit more than half of all of it. Europe maybe around 25%, 30%, Asia regularly slightly higher, but now Europe has overtaken as well. If we look at the mega rounds, which are $100 million plus, we have 105 deals in Q1, which is relatively low when we compare to 2 years ago. I'll show you later. And the next snapshot is on, as we are talking, everybody talks unicorns. There are 1,232 unicorns currently still held private, but the new unicorn creation was relatively low in the last few quarters. And in Q1, it was 19, of which 8 in the US, 5 in Europe, 6 in Asia, and nowhere else. So that's the snapshot on Q1. And then one thing I want you to understand, the different investors into this asset class in venture. You have angel investors with a median round size of about 2 million over the last few years. You have asset managers, which typically come much later stage, in around the 10, 15, 20 million range. Corporate VCs, around 8 to 10 million, and then corporates, which may not have a corporate venture fund, but they have once in a while a deal. It's about 2/3 of what corporate VCs do, private equity comes into much later stage of venture nowadays. And you can see, since it is later stage, typically, it's also a bigger ticket. And then you have VC, which are in the range of about 5, 6, 7 million per median round size. But I will get more into some substance of this. If we look at early stage, you can see it's globally about 2 million. Mid stage or breakout stage, whichever the different names, is in the range of about 20 to 25, 30 million. And then late stage, 20 to about 50 million. However, if you look at what it really means, the top 10 deals in the left box, early stage, are the top one is 100 million. If compared to the median, which is 2 million, this was in Q1. One of them in the wood was 100 million. The number 10 still had 34 million. So there are 10, which are way outliers here, right? So that's in, and then even if you go to Series A, it's a 1 billion an outlier, right? So that's the piece. But there are above 100 million. You go to the mid stage, which is also into 2.8 billion a single deal. Where does it fit into the 20 million here? And then lastly, you have also the Series D and E plus around here. So they're all above 100 million, number 10. The 10th largest, up to 2.8 billion. So be careful when you talk numbers and you hear numbers. Oh, the median round size is 2 million, but you can still have 100 million out there. Good. So this is what it looks like on global venture capital since 2015. There was a ramp up, a pretty crazy time in 21 and partially in 22. But it's been a drop off significantly in 23. And this is still Q1. And I'm coming back to this in a little bit more detail later on. But this is what I call the investment amounts. If you look next, exits. Exits have been at that low level with an extreme peak in 21 and a significant drop off. And I will show you later what is the cause and what causes this massive rise and drop. And we are below, as you can see, pre-COVID, just around that. If you look at the number in fundraising, so VCs raising funds, it goes along with the cycle. As you have seen, it's all a similar type of cycles. And if the exits are low, I will come back to this at the end. If the exit volume is relatively low, that means the distribution from the VC funds to the investor is relatively low, and they cannot use that to reinvest again. So it's a catch-22 situation. I'm coming back to this in more details. The ramp up, however, is significant. If you look at globally, broken down in colors, and Europe is 16% in 23, it's been 19 times higher than in 2009. So venture capital on the global scale has grown dramatically. However, it's a drop-off of about half from the peak in 2001. But even though still, if you take 2021 and 22 out, it's still a significant, nice rise consistently, with a few exceptions of the 2 years. What gets invested globally? In 23 was generative AI, no surprise, at 20.7 billion, over 20 billion. Electric mobility, EV batteries, space tech, and so on and so forth. These are the leading segments. However, there's always an amazing cycle. It always changes over time. And I look at Q1 in comparison, generative AI model maker, and generative AI applications is already globally at 13.7 billion in Q1. It's a pretty crazy hype at this moment. And suddenly you see a new one coming in 24, which was not in the top 10, 15, which is semiconductors. Why? AI needs a lot of more power to calculate. So microchips is really on the rise. And what does that mean for Europe? we have seen this before. This is global investments, 20.7 billion in generative AI, and Europe only had 1.5 billion. So where is Europe investing? And it goes by geography, very different. Europe had about the same amount in some leading tech segments, which was about the size of generative AI alone. However, on a global share, electric mobility, Europe has 36%, 43% in EV battery, and in green buildings, where the Americans are almost absent, it's 72%, hydrogen 57%. So these are the areas, and only 7% of generative AI. So it's a different pattern when you look for investments around the world. And so on the rise of Europe, talking about Europe venture, grew slightly bigger, faster, almost 20 times, almost the same as the global, and up to 100, look at this, from 6 billion to 118 billion, it is down to about 8 billion, which still makes it a 10 times increase since 2010. So where is Europe growing between 2019 and 2023? You can see from rapid growth in dark green and to large decline in dark red. But overall, we can say the UK has always been the big giant in Europe at about 20 billion in 23. France overtook Germany. They made a lot of effort in the last 2, 3, 4 years and beefed up investments in venture startups. Germany almost flat between 19 and 23. And then you see the balance. Scandinavia, Switzerland, and so on, around 50%. Norway, Denmark and Norway, way above 100 to 200%. From a much smaller base, we have to make sure you understand that. So, and it varies. In Japan, it's about almost 70% domestic players, right? So it varies dramatically every geography. So I only carved out Switzerland. The impact is significant. In early stage, you have about 3 to 5 times higher median deal size when the corporates in orange are in vis-a-vis the pink, which don't have a corporate ECN, right? So that's in early stage. And it looks almost similar, about a factor of 3 in the late stage. So corporates are damn significant. It also depends now what it means later on for exits. The exits, there were 369 last year around the world. The US takes 176, North America 188, Europe 73, APAC 80, and Israel 10 in comparison. So that is when the corporate VCs are invested and they have an exit. Okay? If we look at what kind of exits, you have acquisitions, buyout, IPOs, merger, others, and secondary. All I can tell you is that the black line going up and down was at 207 billion in 21, and it's down to 29 billion. And I think the key factor for you to understand, acquisitions have also happened. I'm coming back to this. But the value driver of the exit value are the IPOs. Even if they're a lot less, 128 IPOs in 21 generated 52% of all the proceeds, of all the value generated on exits. While it was down, IPOs have the valuations have come down and so on. It's the 51 only contributed close for 27% of the entire stacking. So going global, what does it mean? Look at this. Technology goes global, startups go global, VCs, corporate VCs, and customers go global. And the investors tap into this entire network. So, of the 38,000 VC deals in 23 with 341 billion, I only took out US, Europe, Israel, and APAC. And here's how it goes. 79%, 80%, 30%, and 85% is pure domestic VC, no foreign VC involved. That's what it looks. That means what? 21%, which means 3,000 deals, foreign VCs came into the US. About 2,000 deals, which is 20% in Europe, came from outside Europe. And it goes, Israel has a lot of foreign inflow, and Asia. However, at the same time, the US VCs, the European VCs, they also invest internationally. A significant number of rounds, look at this overall. So it's a truly global play. How about the corporate VCs? The corporate VCs, here we go. They've got about 4,000 deals at 130 billion vis-a-vis VC, which is 38,341 billion. And I carve out the same geographies with 3,500 deals. And it goes as follows. Again, you remember, domestic, pure domestic is 43%. Only foreign is 11%. And the hybrid, which is a combination of a domestic VC, corporate VC, and a foreign VC, is 46%. It's a bit different in Europe and so on and so forth. That means on 1,000 deals they came in, they either go only by foreign or they combine it with a hybrid, as an example on the US. This is how it goes. 1,000 deals, 500 in Europe, and so on and so forth. And the corporates from the US also invest significantly outside their own country. So it's a global play, and tapping into the best startups and talents around the world. How about startups going global? I've been doing this for 25 years, this research analysis. And you can see from the US, there are 4,416 startups. 46% tap into Europe. That's almost half of it. And then the rest goes to China, India, Israel, because they have offices there. That means a physical presence in office. It's not internet sale. It's a physical, solid presence on the ground. And then the rest of Asia. Where does Europe go? Of the 2,094, 680, that's about 1/3, is intra-Europe. And the rest goes, a larger portion even goes to the United States and then to the other geographies around the world. And Israel, with almost no domestic market, right? It goes like half of it go to the US, about a quarter, goes to Europe, and the rest to the other part. So this is their startups go international. And I think what's interesting is to see everybody talks about US and Silicon Valley. So I give you the 1,970 foreign startups with a presence in the US. Okay, these are foreign startups in the US. About a quarter, 523, are just alone in Silicon Valley. And the life science guys are a lot more on the East Coast, just so I'll share that with you. And then you look at the ones that have startups that have international physical presence going to Silicon Valley. From the 2,094 in Europe, 1,144 go to the US. That Europe represents 58% of all foreign startups in the US, of which 269 go to the Valley. That means 51% of foreign startups in Silicon Valley are from Europe. This is how you read this graph. Same from Israel, 10% of the US the Israeli startups going to US, are 200 of them, 66 go to Silicon Valley out of that, which is 13%. It goes on, India, same thing, China, same thing, which has been reduced to political tensions recently, and it goes on and on and on and on. So that basically shows you who ends up in Silicon Valley, because everybody talks Silicon Valley only. And the question is, at what stage do they go? What stage do they go? They go mostly to Silicon Valley when they are revenue pre-profit. Now, the money. Show me the money. Where does it go? Here is the challenge distribution that I mentioned. You can see there are up and downs here. And what it means is we are right now after the super peak. Are we recovering? Yes or no? I can give you an upfront answer. The best time to ever invest into a fund and in startups, it's the moment when the market comes back after a downturn. You can go, I met with Dick Cromley from NEA last month and from Sequoia. Same thing. They're targeting right now. So that's a good time. Look at, again, where's the value coming from? The value comes from public listing. This is the dark brown. And since public listings, the IPOs are way down. There is not enough capital going back to the investors. And what also happens on exit on M&As is recently there, because the VCs need to generate returns, and they're also selling earlier, and the technology is being acquired earlier by the big corporates. And this is the key driver there. Why do I show you this graph? Because the SMI, the Swiss index, look at this, 4% in 23, 5% in Q1. That's no return for me. Look at Nasdaq Composite, 43 and 9. That's the green line there. It's not even Nasdaq 100. So what I want to share with you is that venture capital correlates much closer with the Nasdaq Composite. It's a much higher return. It has more volatility though, right? But if you are an asset allocator, where would you put your money? At SMI 4%, 5%, or would you rather be at a much higher level? Then it comes to venture capital, and there are all the different asset classes here. I highlight in red. Venture capital has all these cycles, but look at every half the time, venture is in top 3. And then you have a few years where it is much lower. It goes up from 57%. On the top, it can be 13% in the same year, still being on the top. So 20%. So it depends which year you're looking at. But venture typically half the time. I'm almost done now. And this is the disparity of the top 10% in the blue bar, the bottom decile on the bottom, and the yellow dot is the median IRR. And you can see this is way above, and this is global. So if you can access the top VC funds that I'm showing here, is a small group that creates these spectacular returns. And then you have the middle part that returns the money, which we have seen, which makes it the median. And then you always have the few funds with losses. So the question will be, is this fake news? No, it's venture reality show. That's what I call it. With that said, I'll leave the takeaway. 1 minute for the takeaway? Sure. Okay. Record 21, VC, corporate VC, followed by a significant landslide that we have seen. I highlight in yellow, and these questions will be answered during this forum here today. The VCs. Is it going to continue to increase? Deep tech investing, will it be the focus? It will be, I'm saying in blue, it will continue to be the focus of VCs, but will it be combined with international deals? Cross-border has grown at all ends. Will this trend continue? Yes or no? We have seen with China, there have been significant differences, but is China the benchmark? Yes or no? Corporate VCs are now super significant players. They have come now to seed stage. I see the first corporate VCs coming to seed stage. What does that mean to startups? Is that risky? Yes or no? We'll discuss this on the panels. On IPOs and scale-ups, as we have seen, we need IPOs. The question is, where is Europe able to catch up? Because the very biggest deals are all on asset, right? And I guess it will be on my session then debated as well. And the best VC returns, as I mentioned earlier, for an LP or an investor into a VC fund, is it before the bubble, during the bubble, after the bubble? How about investing? So these questions will be answered, at least on my panel, and I'm sure also on other panels. With that said, don't ever give up. Being the entrepreneur or the investor. My time is up. I have a red now. There we go. Thank you.